Your bank just charged you $35. You didn't buy anything, you didn't overdraft, you didn't miss a payment. The money just left. And here's the thing that should terrify you. You probably didn't even notice. Most people don't. That's exactly the point. Banks know something you don't know about yourself. They know you're not checking your statements. They know the exact psychological threshold where a charge becomes invisible, where it lands below the noise floor of your awareness. And they've engineered their fee structures around that exact blindness. The $35 isn't random, it's calculated. It's been A/B tested in boardrooms you'll never enter, defended by lawyers you'll never meet, and defended using data harvested from millions of accounts like yours. This is about the invisible tax on being alive in America right now. And once you see it, you can't unsee it. Let's start with the most common one, the overdraft fee. Sounds straightforward, right? You spend more than you have, the bank covers it, you pay $35. Consequence for irresponsibility. Except that's not what's happening. Not even close. Here's what actually happens. You have $200 in your checking account. You swipe your debit card for $150 at the grocery store. Your account is now at $50. Then, before that transaction fully clears, we're talking hours, sometimes days, another charge hits. Maybe it's a subscription you forgot about. Maybe it's a gas station pump authorization that's higher than your actual purchase. Maybe it's a pending transaction that hasn't settled yet. Your balance drops below zero. Not by much, maybe $12 under. But now, instead of the bank declining the transaction and forcing you to use a backup payment method, they approve it. They cover the $12. And they charge you $35 for the privilege. You just paid nearly 3 times the amount you actually overspent to borrow $12 for a few hours. But wait, it gets worse. The bank doesn't just charge you once for this service. They charge you again and again. If you're at negative $12 and another transaction hits before you deposit more money, that's another $35 fee. The average person who gets hit with overdraft fees, they get hit multiple times in a single month. Some people get charged $300, $400, even $500 in overdraft fees on balances that were only negative by small amounts. This isn't accidental design. The banks deliberately process transactions in a specific order to maximize overdraft fees. It's called high-to-low processing. Here's how it works. You make 5 transactions in a day. 4 of them are small, $5, $8, $10, $12. One of them is large, $150. But the bank doesn't process them in the order you made them. They process the $150 first, then the smaller ones. Why? Because once your account goes negative from the $150 charge, every single one of those smaller transactions triggers an overdraft fee. If they processed them chronologically, you might only get 1 fee instead of 4. The bank chooses maximum fees over accuracy. In 2020, the FDIC estimated that overdraft fees generated $15.3 billion in revenue for U.S. banks. $15 billion. That's from approximately 80 million overdraft fees charged that year alone. Most of these fees are paid by people earning less than $25,000 a year. The poorest 10% of Americans pay the highest percentage of their income toward these fees. This is a wealth transfer machine. Money flowing from the people who can least afford it to shareholders who own stock in institutions they'll never step foot in. But overdraft fees are just the opening act. Then there's the monthly maintenance fee. This one is deceptive because of its name. Maintenance. Like your bank is maintaining something. Like they're doing work. The maintenance fee is typically $5 to $15 a month. Seems small, right? You probably don't even register it. But here's the mechanism. The bank charges this fee to every account that doesn't meet certain criteria. Maybe you don't have enough direct deposits. Maybe your balance isn't high enough. Maybe you don't have a credit card with them. The fee is the bank's way of saying, you're not profitable enough to us, so we're going to extract money until you are, or until you leave. The cruelest part? Some of these fees only apply to people who can't afford to keep higher balances. If you have $10,000 sitting in your account, congratulations, no maintenance fee. If you have $847 and you're living paycheck to paycheck, that $12 monthly maintenance fee just became 17% of your monthly profit margin. The system punishes the poor for being poor and rewards the rich for being rich. And it does it so quietly that most people accept it as just how banking works. Then come the inactivity fees. Some banks charge you money for not using your account, not for costing them money, not for fraud, for existing, for choosing to keep your money there but not make transactions. You're charged anywhere from $5 to $25 per month if you don't use the account frequently enough. This is psychological warfare. The bank is training you to use credit instead of debit because credit usage is more profitable for them. It's engineered dependency. Now add the NSF fee, non-sufficient funds. This is different from overdraft fees because the transaction actually gets declined. But some banks charge you anyway. $20 to $30 just for attempting a transaction you didn't have the funds for. You didn't borrow anything, the bank didn't cover anything, they just said no and charged you for the no. Then there are the foreign transaction fees. You travel to Mexico for a week. You use an ATM in Cancun. That's anywhere from $2.50 to $5 per transaction, plus another 1 to 3% of the amount you withdrew. You spent $500 total at ATMs abroad? That could be another $60 to $100 in fees for money that was already yours. And here's where it gets genuinely sinister. The wire transfer fees. You want to send money to a family member. Maybe it's an emergency. Maybe it's a down payment on an apartment. You go to your bank and say, I want to wire $2,000. The bank says, that'll be $15 to $30 to do the transfer. $15 to move electronic information. They charge the person sending the money. Sometimes they also charge the person receiving the money. Both sides of a single transaction, both paying fees. A transaction that cost the bank pennies to process. Stop for a second. Think about what you've just accepted as normal. You're paying a company to access your own money. You're paying them for the privilege of giving them your money to store. You're paying them when they make a mistake. You're paying them when you make a mistake. You're paying them for not using them. Most people accept this because they were never given an alternative that seemed realistic. The big four banks, JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, hold about 45% of all deposits in America. When you see a bank on every corner, it feels like choice. It isn't. It's saturation. And here's the thing that banks are betting you don't realize. These fees aren't mandatory. They're engineered. They're optional, but they're disguised as inevitable. In 2021, a phenomenon started happening. People began switching to online-only banks. Banks with no physical branches, no tellers, no overhead. Chime, Ally, Charles Schwab, Capital One 360. These banks don't charge overdraft fees. They don't charge maintenance fees. They don't charge NSF fees. Because their business model isn't extracting money from poor people. Their business model is volume. They make money from the interest they earn on lending out your deposits and from transaction data, not from charging you for existing. When Chime launched, they made a specific promise. No overdraft fees, ever. Not even one. No maintenance fees, no hidden charges. Free transfers, free ATM access. The response was immediate. Millions of people switched. Chime now has over 13 million users. Their revenue model proves that a bank doesn't need to prey on its customers to be profitable. So why hasn't everyone switched? The answer is darker than you think. Traditional banks have something called customer stickiness. It means the more accounts you have with them, the harder it is to leave. You have your checking account, your savings account, maybe your mortgage, maybe your credit card. The infrastructure is complicated. Moving everything feels like too much effort. Banks know this. They count on it. They know that even though you could leave, the friction is high enough that you won't. So they keep pushing. They keep charging, because they've calculated that the revenue from fees is worth the 5% of customers who do finally leave. It's a numbers game, and you're a number. But the trap goes deeper still. When you accept that these fees are normal, you're accepting an entire philosophy about your relationship to money. You're accepting that you don't really own your money. You've entrusted it to an institution that views you not as a customer, but as a source of extractable value. The relationship isn't mutual. The bank doesn't need you, but you've been convinced you need the bank, so they can charge you for that need. The credit score system reinforces this perfectly. Your credit score is essentially a score about how profitable you are to lenders. If you pay your debts perfectly on time, with interest, you're creditworthy. You've proven yourself to be a reliable source of profit. The entire financial system is built to quantify and monetize your behavior. The overdraft fees, the maintenance fees, the interest on credit cards, they're all part of a larger system designed to make you financially dependent on institutions that profit from your dependence. Here's the mechanism that most people miss. The reason overdraft fees are so profitable is because they're not distributed evenly. They're concentrated. The top 10% of accounts that pay overdraft fees, they pay 80% of all overdraft fee revenue. And within that group, the absolute highest concentration, the people getting hit with overdraft fees multiple times per month, are people living paycheck to paycheck. People with the least margin for error. People who are already stressed about money. The system doesn't just take their money. It concentrates their stress, their shame, their feeling of powerlessness. And it turns that into profit. Some people, after being charged enough overdraft fees, just stop using their bank account altogether. They switch to cash, to check cashing services, to payday lenders. This is called unbanking, or banking the unbanked, and it's a profitable business in itself. A payday lender might charge 400% APR on a 2-week loan. That's insane on its surface. But if you've been crushed by overdraft fees and you need money right now, suddenly 400% interest seems rational compared to another $35 charge. The system creates the conditions that force you into worse alternatives, and those alternatives are also profitable. This is the invisible architecture of American financial life. It's not a conspiracy. It's just capitalism operating exactly as designed. Banks are legally obligated to maximize shareholder value. If that means charging poor people fees they can't afford, and if the regulatory penalty for doing so is less than the profit, then it's not just allowed, it's required. The CEO who doesn't extract this value is failing in their legal duty. But here's what happens when you finally realize this. When you see the system clearly. You realize that switching banks isn't enough. Yes, switch. Go to Chime. Go to Ally. Avoid the fees. That's the obvious move. But the deeper realization is that the entire system is built on your acceptance of it, your compliance, your belief that this is just how money works. The moment you question that belief, the system becomes fragile. If everyone switched tomorrow, JP Morgan Chase wouldn't have $35 billion in annual profit. That profit depends on your continued participation in a system that quietly extracts money from you. You also realize something else. You're not the customer. You're the product. Your deposits are the inventory. Your behavior is the data. Your fees are the profit. The bank's customer is actually the investor, the shareholder, the institution buying their stocks. You're what they sell. So what do you do? The obvious answer is switch banks. And that's not wrong, but the deeper answer is harder. It's to stop accepting that financial systems are inevitable. To stop believing that banks are neutral institutions just providing a service. To recognize that every fee, every charge, every surprise debit is a choice made by people to extract money from people like you. And then to ask yourself, what other systems am I accepting as inevitable that are actually designed to extract value from me. Once you see it in banking, you start seeing it everywhere. In your phone bill with hidden line item charges. In your cable subscription with fees buried in the fine print. In your gym membership that's designed to be hard to cancel. In your apartment lease with move-out cleaning fees that are impossible to avoid. In your credit card that charges you for late fees even when you're a loyal customer. The entire economy is built on invisible extraction, on the belief that most people won't notice, on the hope that you'll accept it as normal. And the trap is that this realization doesn't make you safer. Knowing that your bank is extracting fees doesn't stop the fees. Switching banks helps, but it doesn't change the system. You just escape to a smaller, newer bank that might eventually get large enough to become as predatory as the one you left. It's not a solution, it's a temporary reprieve. The real trap is this. The more you understand the system, the more powerless you feel within it. Because you can't opt out of banking entirely. You can't survive in modern America without a bank account. Credit cards require a bank account. Mortgages require a bank account. Direct deposit requires a bank account. Employment requires a bank account. You're not free to choose. You're only free to choose between predators. And the banks know you know this. So they keep charging. They know you're trapped. They know you need them more than they need you. And they'll keep extracting until the regulatory environment changes, which it won't, because banks lobby governments to prevent regulations that would stop them. Or until everyone switches to a new system, which won't happen because the new system eventually becomes the old system. This is the real mechanism of the invisible tax. It's not just the $35 charge. It's the knowledge that you're being charged, combined with the certainty that you can't escape, combined with the awareness that complaining changes nothing. It's the slow erosion of your sense of autonomy. Every charge is a small message. You don't control your money. We do, and you've accepted it. That's the real fee, the one that doesn't show up on your statement. The trap was accepting that this was ever normal in the first place.